Hello and welcome. My name is Alex Weiss, President and Wealth Manager at Napier Financial. I'm joined here by Chief Investment Officer, Mr. Tom Fletcher. And today, midday on May 12th, and for those who haven't viewed any of these videos before, we're just going to go through briefly broad, high-level topics that are driving markets these days. And Tom, thanks for the time as always, but let's just jump right into it. So what do you see going on in the markets these days?
Thanks, Alex, and thanks everyone for joining us once again on another one of our videos. As usual, there's quite a bit going on these days. We had a pretty rough month of March, thanks mostly to the war in Iran and the closure of the Strait of Hormuz, which at one point pushed oil prices near $120 a barrel. Stocks have since staged a serious rally, are now trading at record high prices today. It's a little bit easier, but we're right there. This is a classic example of what can take place with markets. They often tend to defy logic and ignore current events and instead focus on the long-term picture. At the time we're filming this, the Strait of Hormuz still remains closed. The U.S. continues to blockade Iran. Oil prices are still north of $105 a barrel, and peace talks between the U.S. and Iran seem to be in a stalemate. Whether you agree or disagree, markets appear to have discounted that this is likely only a temporary issue that will be resolved relatively soon rather than a systematic long-term risk. And that's a good thing, because with jet fuel prices skyrocketing, gasoline and diesel prices rising, and fertilizer and other shortages appearing, a long-term dragged out quagmire would not be good for the health of the global economy, and most likely would lead to embedded inflation. Another very important ingredient taking place that has definitely contributed to higher market prices has been another record earnings season. Just when many thought the AI trade was beginning to lose momentum, strong tech earnings, particularly from the Magnificent Seven companies, along with continued heavy AI-related spending, have fueled another quarter of excellent corporate earnings growth. It definitely appears at this juncture that AI spending isn't going to slow down anytime soon, and that remains positive for the outlook for corporate earnings growth, and again, particularly for the tech sector. Outside of earnings, we've had a pretty good April employment report released last week that indicates the labor market is at least stabilizing. Additionally, despite higher prices due to the war, there's no broad indications yet that the consumer, which represents about 2/3 of the U.S. economy, is pulling in their horns and are cutting back on their spending. Of course, the Strait of Hormuz remains closed, and if it remains closed for an extended period of time, the consequences would not be favorable for the consumer or the economy the longer that drags out. One other point worth noting is that the bond market tends to be much more sensitive about the effects of inflation than the stock market. The benchmark 10-year Treasury yield, while it is creeping up a bit, still doesn't seem to be flashing warning signals and remains below that 4.5% level. On a few occasions, we've noted that if yields begin to rise and approach the 5% level, that could be a point where the stock market may pay more attention and it could weigh on prices. Again, yields remain fairly benign at this juncture, and they indicate that the market believes that long-term inflation is not currently a major threat or an issue.
Great, Fletch. Awesome information. Thanks for sharing. And as we continue to look forward, what additional thoughts do you have on the market?
Well, I always seem to conclude these talks with an asterisk.
You have to, Fletch. You have to.
You do. I'm going to do the same this time around as well. We have markets looking past the conflict in the Middle East and trading at their all-time highs. We have accelerating earnings growth, ongoing AI spending, a resilient economy, and a seemingly healthy consumer. What's there not to love, right? Well, while the market's telling us that things are pretty much hunky-dory, there are a few wrinkles worth noting. The first would be that markets tend not to go up in a straight line without a pause or a pullback. And given, at the time of this filming, that in the last 31 trading days since March 30th, the S&P is up roughly 17%, and the NASDAQ is up roughly 26%. Those are very big numbers. The question is, now that we've had this massive rally, how much good news is baked into the market at these levels? My point being, it's probably unlikely we'll see returns like this over the next 31 days. And it may take a while for markets to digest the recent gains, which could lead to some choppiness ahead. Another aspect worth noting is that this recent leg up has been driven almost entirely by tech. For example, the SOX semiconductor index is up nearly 71% since late March. Repeat, 71% on the outlook for strong AI spending. On the other hand, value stocks have risen only just about 12% during that time period. So that's quite a contrast. So the question is, how much further can tech go without pulling the rest of the market up, or be subject to further profit taking, or some profit taking at all? Time, of course, will tell, but from our perspective, for the health of the market, we'd like to see the rally broaden to include other sectors in addition to just tech. There are a few other areas worth mentioning as well. One would be that Kevin Warsh will be confirmed this week as a new chairman of the Federal Reserve. He takes over at a tricky time for the Fed, with inflation being impacted by the war and the administration pushing for much lower interest rates. Questions are likely to remain about the Fed's independence and how it will react to political pressure while maintaining its dual mandate of controlling inflation and supporting economic growth. Another area to note will be Trump's visit to China later this week. Important agenda items will be likely tensions in Taiwan, and then the trade imbalance between the US and China, and tariffs. It'd be interesting to see if anything concrete comes out of the meeting. And finally, we'll just mention that once again, further tariffs have been threatened by the administration if the EU doesn't ratify its trade agreement with the US by July 4th. So I guess in conclusion, there's always a lot going on these days in the markets, and we're keeping a very close eye on things.
Fletch, we all appreciate the information and the knowledge sharing. If anyone has any questions that want to talk to Tom, Fletcher, myself, anyone on the team, please always feel welcome to reach out, and know that that your fully integrated financial planning team is here to make sure that no matter what choppiness is ahead, that we're going to be here for you. Thanks again for your time, and we look forward to seeing everybody soon.
Thank you.